Good day and welcome to our latest UTS Finance Research Showcase. My name is Lorenzo Casavecchia and I'm the Associate Head External Engagement of the Finance Department. On behalf of the UTS Business School, I would like to welcome our audience, presenters, and industry guests. Thank you all for joining us today. Quick disclosure, please note we are recording this event. So by partaking in our event, you agree to this recording. I'm very proud of the Research Showcase events that my colleagues, Dr. Gerhard Busch and Dr. Caroline Richards have put together in the past. And I'm equally proud that we have such a wonderful mix of academic and industry perspectives in our events. We are very excited to have 3 UTS Finance researchers today who will present some of their latest fresh finance research. Topics include inequality of finance, dual class shares, and investments in emotions. To allow the audience to meet our presenters and industry guests, I would like to ask each of the presenters to briefly introduce themselves. Please share your backgrounds and expertise. I would like to start with Dr. Jing Su. Jing, if I may ask you to quickly introduce yourself, please, to the audience. Thanks.
Hi, hello. My name is Jing. My research interest is in the corporate governance, gender diversity, and corporate social responsibilities. And today I'm going to present one work about the diversity.
Jing, thanks for joining us today and for agreeing to present your fascinating topics on inequality of finance. Our second presenter is Dr. Hulley, who will present on dual class shares and firm innovation. Hardy, may I please ask you to quickly introduce yourself to the audience? Thanks.
Yeah, good afternoon, just afternoon. So my name is Hardy. And I work in a number of different areas in finance. I've worked in quantitative finance for several years, but recently I'm starting to work in corporate finance, and the research I'm presenting with is work done with my PhD student on dual class shares.
Hardy, thanks for joining us today. We really look forward to your presentation. Our third presenter is Dr. Yeung, who will present on the art of investing in emotions. Danny, may I please ask you to quickly introduce yourself to the audience? Thanks.
Hello, everyone. My name's Danny, and my research areas are based basically on anomalies, investment strategies, and I've looked into the impact of uncertainty. And today I'm going to talk a little bit about how we can explore investing emotions in investment strategies.
Thanks, Danny. To have some perspective on the industry relevance of our research presented today, I'm delighted to introduce Dr. David Walsh. David is an honorary associate with the UTS Business School and is the head of investments at Real Index Investments. As a PhD trained investment expert, David is the ideal sparring partner for our researchers today. David, welcome to our research showcase. May I please ask you for your brief self-introduction? Thanks.
Of course, and thanks very much for the opportunity to be here today. Hopefully I can add something. My background, I was an engineer by training originally, moved into finance, moved in academia for a little while before coming to the markets 20-something years ago. And I've worked in quantitative investing since then, primarily in equities, portfolio management, research, trading, and the last 10 years or so running investment teams. And I'm currently been with Real Index as head of investments for about the last 3 years.
Brilliant. Thank you, David. And I look forward to your comments on the research to be presented pretty soon. Before we start, just a little bit of housekeeping here. The format of today's event is simple. For any topic, we will spend 5 minutes each on presentation, industry comments, and audience Q&A. If the audience has any questions, please submit your questions in Zoom via the chat button, and we'll try to attend to your questions during the last 5 minutes in each presenter's 50-minute slot. I would like to start with our first topic today. Women make up about 35% of education students in STEM subjects globally. In some regions, the number is often below 20%. So it is uneven progress in mind, highlighted on the International Women's Day. It is evident that there is still much work to do here. Our first speaker, Dr. Jing Su, will tackle this important and pressing issue. How diverse in terms of gender and geography are top scientists in finance? Jing, please feel free to share your screen. The mic is yours.
Hello, good afternoon. Thanks for giving me this opportunity to present this work here. The inequality of finance. This is a joint work with Renee Adams from University of Oxford. So in this study, we're going to ask how diverse are thought leaders in academic finance. So this is looking at our own profession. To answer this question, I use data sets of over 120,000 scientists who are ranked in the top 2% of their own scientific fields, according to their citations. So these scientists are from 175 scientific fields over 150 countries. Even though I wish to take credit of the data, but the data is actually not compiled by us. We just borrow this data to answer this question about diversity. To understand the diversity in finance, we also pick up some benchmarks. We use the economics and the STEM field as our benchmark, that is science, technology, engineering, and mathematics. Both scientific fields, these two fields, are known for lack of gender diversity. The other reason to pick up the economics is because finance is very related to economics. It was carved out from economics about 40 years ago. So if we look at the women's representation in the top scientists, there are about 10% of top scientists in finance are women, and the ratio in econ and STEM are 11%. If we look at the scientific community as a whole, that is 17%. So finance is ranked as 132 out of 175 fields. So it's at the bottom 1/3. So overall, we found the diversity, the gender diversity in finance is relatively low. And next we look at the geographic diversity. So we found 79% of the scientists in finance are actually working in US or UK. And this corresponding ratio for econ and STEM is 69% and 43% at the bottom of this row. And if we look at the whole scientific community, 50% of top scientists are from UK or US. So again, the geographic concentration of scientists in finance are much higher than in econ, STEM, or the whole scientific community. So after we document the seems lower diversity in finance, the next we're going to explore is why there are so few women in finance. But to explain why, this question is very, very difficult to pinpoint. So here what I'm trying to do is I'm going to show you the data I have, but I leave that to you to decide whether you will follow my interpretation of the data or not. So let's look at the graph here. So in this graph, I plot the ranks, the relative ranks of men and women within each field. So each spot here represents one field. For any spot is above that 0 line means within this field, male scientists are usually ranked higher than female scientists. So this is among the top scientists. So what we found here is overall, in majority of the scientific field, men's ranking are higher than women's. But if you look at finance, this is below the 0 line. In finance, even though there's not many female scientists, their ranking is actually higher than men in finance. So I do the similar thing in the next two graphs, but this in the bottom side, this is a citation per paper. So any spots below the line means the woman's citation per paper is higher than men's within the field. In this, on the right-hand side, is the number of papers. So overall, we found, even though if we look at the number of papers in majority of the field, men publish more papers than women. But if you look at the citation per paper, so we see a different story. So it seems if we look at individual papers, the woman's paper has a higher impact than the man's paper. So overall, I think this lower representation of a woman and better ranks within finance point to a selection story here. So what I mean by selection is if someone has to overcome barriers to reach the top, then whoever manages to survive and reach the top will be of higher quality. So currently in this field of gender gap in labor market outcome, a lot of studies look at preference. In here, I'm not saying preference doesn't matter. What I'm trying to say is, in addition to the woman's preference, there are still some barriers women have to overcome to reach the top. And that's the end of my presentation, and I'm looking forward to any questions.
Jing, thank you very much for this presentation. And David Walsh will be now providing his industry commentary.
Thank you, Lorenzo. If you could put the slides up for me. Thank you. Thanks very much. So firstly, really good paper. I like the topic. I think it's critically important to understand better, the drivers of thought leadership and innovation in finance. What I've tried to do here is, on the first page, just summarize my understanding of what you're trying to get at, and on the second page, provide some hopefully useful comments, although this is a pretty complete paper and there's a lot of really interesting stuff in there that I haven't been able to dive into in a short time. My summary, and at the top of it, I think, without abstracting too far, innovation appears to improve as diversity of thought leadership improves. So the more diversity of thought leadership you get in any field, the better innovation tends to be. And there's some evidence to suggest that in psychology and in other fields as well, which you cite. But diversity in thought leadership in finance appears to be low. And that is measured here using gender diversity. It's certainly worse in finance than it appears to be in other sciences, even economics. So the question you're asking here is this job solely due to what women believe, or do men's beliefs play a part in this as well? So the study itself takes top 2% of, as Jing's mentioned, top 2% of all cited authors in different fields as a proxy for thought leadership. Looks at concentrations in finance, in particular, are among men and among US and Great Britain domiciled by a large number. So very concentrated in those two fields. It appears that women in top 2% are more cited than men and have more impact. I think you mentioned that, and that's an interesting result. A couple of comments I made there, which are probably sort of peripheral and perhaps a bit of hand wavy, but hopefully give some sort of lead into what I was thinking about. The first one is probably the thing that struck me most up first time. Probably there's no other way to measure it, but you are proxying thought leadership with citations. And I think there's a number of cases where thought leadership has come from poorly cited sources. People haven't been very cited have come up and jumped in and done what they've done. And quite often well-cited authors are just repeating or confirming other sources. So perhaps citations isn't quite as good a measure of thought leadership as otherwise. What you use in place of that, I have no idea, but it just seemed that it was having data available is a good place to start. But perhaps thinking about what thought leadership might look like if you didn't have citations is a place to start. My second comment was, and this has nothing to do with your paper necessarily, but one thing I've been reading a bit about recently is understanding the replication crisis in finance and other sectors, and the inability to replicate studies, and the definite leaning towards better encouragement and support of replication. We want to encourage thought leadership, but can thought leadership and improvement thought leadership be represented in a replication sense? Do we need more replication? Do we need more thought leadership? How does that sort of balance work? I don't really know the answer to that one either. It's just a thought that occurred to me on the way through because I was reading something else. One thing I would like to make a point about, given our work in the industry, is that industry culture, in particular in finance and how it's perceived, really matters. And I think that's highlighted a few times in your paper. Finance industry culture has always been very, very heavily male and US centric. It's always been that way because of the evolution of the industry and because of the way the institutions themselves work. That's not saying it's gone, that's certainly there, but I think it's being addressed slowly. We do see a lot more evidence, particularly from the asset owners and among asset managers, of improving hiring practices and doing better, getting better understanding of diversity, whether it's gender diversity or other types of diversity as well. We're Real Index, we're doing that at the moment. We're thinking a lot about that sort of thing, and First Sentia, the broader organization, thinks the same. We're addressing them, but the problem associated with that is probably more, not just hiring practices. I think there's more to do with the way the education process works, more to do with broader market culture and culture in general than just the industry itself. And I don't know what the answer to that might be either, but just I think there's been some tendency to blame finance industry culture as being the main culprit here. I think there's a lot more going on underneath it. This is not academic side of things, just the finance industry itself. The last comment, which is something that I'm paraphrasing myself here, one of the things you said was that effectively women don't believe being brilliant is useful in academic finance. Why not? I don't understand why not. Is it a behavioural self-image thing that you mentioned? Is it an imposter syndrome? Probably. That's been known to be worse among females than in males. If that's the case, how can it be addressed? Do you have any suggestions, policy suggestions, as to how we might go about addressing that, or is it too early? So I didn't have much more to say other than I like the paper a lot. I learned an awful lot, and hopefully I've added some thoughts to what you've done.
Thank you very much, David. Jing, I'm handing those questions over to you. I noticed that you already addressed one question in the chat about the effect of the pandemic on the outcome. So we won't get back. So if you could please respond to David. You have about 5 minutes. Thank you.
Yeah. Can you go back to David's slides, the last slide?
Sure.
David, thanks for these comments. I think they are very useful. Let me try to answer your comments. The first thing, I kind of agree with you. The citation may not indicate the thought leadership, but restricted by what sort of data we have. So we did some check. So we had in the paper, we list all the females in finance because we're familiar with the finance scholars. So we actually went through the list. So most of scholars on that list was pretty well known in our field. We kind of agree they are the leaders. And then we also noticed there are a few other persons who's well known in finance, but they are not on the list. So when to check the data, actually they are classified as economists because they publish both in econ and finance. So the data structure just classify them as economists. And the other thing we also checked is we looked at how many of these women are journal editors of the top 5 or 6, top 6 finance journals. We actually found the coverage is pretty good, especially for women. For men, it's not that good, but especially for women, a lot of them are actually the editors of the leading journals. I think that also a sign for the thought leadership. So everything we done is based in finance only because that's the area where we can easily verify. So I cannot say that for any other field we used in our study. The second point is really interesting, the replication crisis. In fact, the referee of this paper also pointed out the same thing. But again, due to the data restriction, we don't really have this data on how many of the papers can be replicable. So there are some studies on retractions. So they're looking at the referee actually sent us a paper about the gender differences in retractions, but we think since our paper doesn't say anything about the quality, this kind of quality, so we don't want to really make that claim there is any difference, rely on some other paper. So we think this is potentially an interesting future research area. So both co-author, my co-author and I, we are thinking about doing something on this line. And your third point is actually in line what we're trying to sell. So the background of this project is so many people say it's about a preference. It is women prefer to work in other fields. They don't like to work in the finance industry, or they prefer to working in the middle level positions, because if you go up, the time is much more demanding, and then the competition is higher. So there are some psychological study showing women are not perform not as well as men in a very highly competitive setting. So giving a lot of papers point to the preference. So what the point we want to make is culture actually matters. There are other reasons rather than performance, a preference. So if it's preference alone, why the woman actually in finance ranks better? So if the woman in general just don't like finance at all, so why this one woman managed to stay and to get into the list is actually have quite good performance. So that is exactly what we're trying to say. It's the background information is everyone's focus on the preference, and we're trying to say no, the culture matters. So the last one, Lorenzo, what's the last one?
We have about a few seconds left. Thank you. Okay, just let me elaborate. I think the measure, this one I didn't mention in my presentation because of the 5 minutes time restrictions. So this measure we use, brilliance, is man and woman's belief on
the importance of brilliance to be successful in the field. So it seems men thinks raw talent is very important. And on the other hand, maybe woman believes, I don't know, whether maybe hardworking or something, but compare man to woman, they seems don't think brilliance is as important as men think about the brilliance in be successful.
Thanks, Jing. We got to move on to our next topic. When a company issues stocks, 1 share equals 1 vote. But increasingly, companies have started issuing dual class shares, which gives the founder and inside shareholders super voting rights, in which 1 share equals 10 or more votes. In 2017, 25% of stocks had dual class structure, vis-a-vis only 1% in 2015. And in the tech sector, there is in excess of 30%. So some people see this as an issue, others as an opportunity. This is the topic addressed by our next speaker, Dr. Hulley, who will present his latest findings on dual class shares as a vehicle for financing innovation. Hardy, please feel free to share your screen and start your presentation. Thank you.
So thanks very much. Yeah, so as I mentioned before, this is a joint work with my PhD student, Yeung, and in fact, Lorenzo as well, who's hosting us this afternoon. And this is work, part of a larger project we're doing on dual class shares. So for those of you who don't know, dual class shares are shares that are what happens when a firm issues shares with differential voting rights. And typically what would happen is that some shares will be non-voting shares and other shares will be voting shares. And the idea is that the firm will issue voting shares to the founders and the managers and certain key shareholders, and the rest of the shareholders and public at large will be allocated non-voting shares or inferior voting shares. And what this means in the case of a dual class firm is that these firm insiders, the founders, the managers, etc., who hold these super voting shares, end up exerting complete control over the company. The external shareholders, the people who hold the non-voting shares, really have very little say. Now, the literature on dual class shares has really fallen in the within the paradigm of the literature on anti-takeover provisions. So typically, dual class firms are regarded as, or dual class shares are regarded as a type of anti-takeover provision. And so they can be there with poison pills and staggered boards, etc. And the literature has looked at dual class shares in this way, and that means that you're looking at the advantages of anti-takeover provisions versus the disadvantages of anti-takeover provisions. So the advantages of anti-takeover provisions are protection from short-term investors, benefits of decision-making under asymmetric information, the ability to invest in long-term projects because you don't have these external shareholders who can influence or prevent you from taking sort of hits to revenue in order to follow a long-term investment strategy. The disadvantages of dual class shares are, or the disadvantages of all anti-takeover provisions really, are related to manager entrenchment. And so they're things like empire building, tunneling, extraction of private benefits, etc. Now, as I said, we're going to be looking at dual class shares in particular. A little bit of a brief guide to the literature that exists so far. So in the beginning of the literature on dual class shares, the focus was almost entirely on the governance aspects. And so there are a couple of early papers that were written that are widely cited. There's a paper of Gompers and Ishii and Metric, 2003, and they found that in general, anti-takeover provisions that weaken shareholder rights and empower management and insiders have a negative impact on firm value. And this they found to be true of dual class shares in particular. A later paper by Ron Mitsoulis and co-authors showed that as the wedge, now what the wedge is essentially the difference between the number of voting shares and the number of non-voting shares. As that wedge increases, which means to say that there are far more non-voting shares than voting shares, corporate cash holdings become worth less, CEOs start to compensate themselves more, and managers engage in value-destroying decisions. So these are all the downsides, the sort of governance downsides of dual-class shares. A more recent stream of papers have started to look at the positive effects of dual-class shares. So we really kicked off, our work was inspired to a large extent by this paper of Jordan and co-authors in Journal of Corporate Finance. And they found that dual-class firms face less short-term market pressure than comparable single-class firms, and the dual-class share structure increases market valuations for high-growth firms. Two recent preprints from 2020, they're not published yet, but very, very interesting. The one shows a positive association between the dual-class share structure and all qualities of innovation. So the idea is that firms that issue dual-class shares tend to be much more innovative. And the reason why is because if you issue dual-class shares, outside shareholders can't impact your decision to engage in innovation, which is obviously long-term investment. Kremers and co-authors have another paper that actually shows that there's a time effect. So dual-class firms have a value, a premium. There's a premium associated to dual-class shares, which exists at IPO, but then gradually decreases over time. Now, as I said, all of this literature tends to look at dual-class firms from the governance perspective, or they tend to look at the effects of manager entrenchment. We became interested in another aspect of this. What we realized is that there's something else about dual-class shares that people haven't really focused on, and that is dual-class firms, or the founders or innovators, the people that start dual-class firms, are much happier to raise equity capital. They're much happier to issue more shares, because by issuing shares, they're not relinquishing control of the company, because they'll be issuing non-voting shares. And this means to say that dual-class firms, especially young, innovative dual-class firms that need equity capital, will be much happier to raise equity capital. The innovators or the founders of the firm are not going to be so concerned about what will happen if outside shareholders take over control of the company. And so we came up with this idea that instead of focusing purely on DCS and the dual-class share structure and looking at the advantages versus the disadvantages of anti-takeover provisions, we should think about this as actually a channel for raising capital. So firms that really need equity capital, if they have a dual-class share structure, are going to be much happier to actually raise that capital. The founder is going to be much more willing to go to the market to raise equity. Now, we'll start off just by presenting sort of two sets of results. I want to focus on this graph here on the right first, because it's really quite interesting. What we're looking at in the vertical axis is Tobin's Q, which is a measure of firm valuation. And what we're seeing here, this red line in the middle is all single-class firms. So we've normalized valuations for single-class firms. So single-class firms have a valuation of 0. And what we're seeing over here is that dual-class firms that engage in higher than median R&D is this top line over here. They tend to have higher valuations, whereas dual-class firms that engage in lower than median R&D tend to have lower valuations. And this is, of course, consistent with the results in that paper of Jordan and co-authors that I mentioned a moment ago. And we can see it in the regression results over here. So if we look at our full sample period, which is from 1991 to 2019, what we see over here is that if we look at this variable here, which is the interaction variable between the dual class dummy, so firms that have a dual class share structure, and the amount of R&D they do, we see that dual class firms that engage in R&D tend to have higher valuations. So there's a positive impact. Of course, the impact for dual class shares overall is negative, as we can see by this dotted red line over here. So what we're seeing there is that overall dual class firms have lower valuations, presumably because shareholders aren't keen on them because of this these governance problems associated. So overall, dual class firms have lower valuations, but dual class firms that engage in R&D have higher valuations. The other thing that we see here is that if we look at our sample, we divide it into subsamples up to 2005, and then from 2005 onwards, what we see is that the effect is greater in the second subsample. And indeed, if we look at the first subsample up to 2005, we see actually an insignificant interaction variable there. But when we look at the second subsample after 2005, we see a very significant effect there. So what we're saying is that this impact of dual class shares on valuation for innovative firms is a recent phenomenon. Now, where we went next is to say, well, what is causing it? and we identified equity issuance as the cause. And you can see this in this result here. You see, if you look at the overall data, you see that dual class firms that issue equity, NEI is net equity issuance, dual class firms that issue equity are in actual fact having higher valuations. And again, we see the same effect in the two subsamples. Over the first subsample, this variable is not significant, but over the second subsample, it is very significant. So we wanted to focus next on this story of equity issuance. And so we look now at the equity issuance of dual class firms. And we see here in this graph that we're looking at net equity issuance, so the amount of equities that firms, issue on the vertical axis. And we see that, again, the single class firms are zero. And we see that dual class firms that engage in high R&D are also issuing more equity. And dual class firms that don't engage in R&D are issuing less equity. Now, this is important because it's been known for some time that if you want to fund R&D, or you want to fund any risky long-term investments, equity is the security you should be issuing. You should be funding it with equity. And I think I'll stop over here.
Hardy, thank you very much for your presentation. I'd like to reach out to David now to hear his view on this research topic.
When the slides appear, again, I've tried to summarize Hardy's paper, or the paper of Hardy and his co-authors, in some way that hopefully framed it for me. And then I tried to put a little bit of a lens on it associated with the way in which I think of the world, which is more associated with investment finance rather than corporate finance, and whether the governance idea there actually matters. So I'll start again by summarizing what I understood Hardy's paper to be about. And first I'll say I couldn't hardly improve on the presentation that Hardy's provided. That appears a very comprehensive summary. So let me go through as my understanding, and then I'll talk a little bit about how I saw it and how we might use it. Proposal that rather than being a governance headwind, dual class shares offer the firm a chance for greater innovation through R&D by protecting management from short-termism in investors. There's an argument around that. They use the DCS indicator, the dual share class indicator, in a dynamic GMM models for growth opportunities using Tobin's Q, R&D intensity, and it's proxied as R&D to sales, and net equity issuance. Clearly, R&D is more valuable for firms with dual class structures. They tend to raise more equity to support the R&D. I like this paper a lot. There's a lot of nice ideas in there. It's got a practical use too in the way that we would think of the world. We think governance is an alpha source. Good governance means better performance. What's interesting here is the suggestion would be that poor governance, measured the classics of omnibus way, actually may be good in some ways. And the question there is, how do we apply it? Now let's try that again, Lorenzo. Last time we changed slides, I dropped out. Hopefully it doesn't happen again. Good, thank you. The premise here is that shareholders are myopic. Are they? Are shareholders not able to identify that some firms perform better than others? So perhaps companies which are dual class and have the ability to invest R&D in better R&D, are they actually badly governed companies? And are shareholders actually that myopic? That's a question that occurred to me because it comes up quite often in engagement. We're talking to corporates, to companies. As a shareholder, we're asked quite often about our views of their long-term R&D prospects and their investment prospects. And we're not talking about next month's or next quarter's performance or next 6 months' performance. We're quite often talking about longer-term issues. So I wonder whether the view of shareholders being myopic actually is a concentrated question, and whether something broader going on there. In yellow, I've put across something which is to do with the way that, again, I think of the world as an investor. We know R&D to sales is a positive alpha factor. We already know that, but it's slow burn. It takes a while to implement it. And if you aggregate R&D over some time, capitalize it, say, over 3 to 5 years, you find it forms a significant component as an intangible asset, if you measure it that way. And that intangible asset itself actually represents better measurement of some adjusted book value than raw book value does. So that's interesting too, and perhaps a way of thinking of what you're looking at, Hardy, associated with an aggregated measure of intangibles via R&D rather than just a single one-year measure, as you got there. This is US only, I think, and so you've talked about only 2 share classes. If you had multiple share classes, there are more than multiple share classes available, Google, for example, maybe that changes, maybe it doesn't. And what about other classes of shares? You've mentioned that there's various ways for capital to be raised, and maybe poison pills and the like are acting as an impediment. What about simpler things that are closer to poor governance, measured that way, like variable interest entities or a controlling interest or even master limited partnerships, are these sort of things, not to get R&D and MLPs, but the idea there might be, are you actually seeing better performance there from companies which have similar characteristics? I don't know the answer to that, but I think it's one perhaps will help to broaden the paper a little bit. I've got some comments on dependent variables at the bottom. That's just for side questions. One thing I will mention is that net equity issuance is generally being measured as taken as a measurement of management hubris rather than one of a positive signal. So you're actually betting against that there a little bit. So we would actually use net equity issuance as a way of measuring whether firms are overdoing equity issuance and consequently going to underperform in the future. And one last comment I'd make before I hand back, or two comments. One is I like the paper a lot. I'm going to take it away and think about it. I've seen the Jordan paper before, hadn't looked very closely at it. I'll go back and have another look at that one as well as this one, because I think there's some interesting stuff in there. One comment I'd make on your charts, which I hadn't picked up until you put them up a second ago, is a lot of the performance associated with good R&D is in the last 10 years, during a period when value underperformed really badly and growth did really well. So perhaps something more underlying that result than just simply the R&D component that you're talking about. But I'll leave that one to one side. That's all I have to say there. And thanks again, Hardy. I really like the paper.
Thank you very much, David. Hardy, I would like to I throw it over to you. I would also like to attach two questions from the audience. One is from Keith. Do you think Australia should allow dual class shares? And the second question is a bit longer, so I'll try to make it short. So Uber listed in May 2019 after it ditched in 2017 the dual class share structure to put a stop to the festering corporate scandals associated with the previous CIO, Kalanick, I think it was the name. If Uber hadn't done so, there would have been more shareholders' concerns and possibly a higher price discount at its IPO in 2019. So the question, can the market weight correctly the benefits of innovation against the risk of poor governance? Hardy, you have 5 minutes to respond. Thanks.
Right. Well, thank you very much. A lot of very good points. So I'm probably not going to address them all. I'm going to cherry pick a couple of them. The first point that David brought up about the myopia of investors. Yeah, the assumption isn't that all investors are myopic, but of course, some investors are myopic. And there are variables that are introduced in the literature to determine how many or what fraction of a firm's shareholders are myopic. So things like whether they have institutions that engage in sort of high turnover in the firm's shares, whether the firm is the focus of a lot of many equity analysts. These are all things that tell you whether this firm has a lot of myopic shareholders or not. And what was done, for example, in the Jordan paper is that they showed that for firms that do have a lot of myopic investors, so by these variables, the impact of dual class shares is more significant. So yeah, the assumption isn't that all shareholders are myopic, but the point is that if there are myopic if a firm does have a high concentration of myopic shareholders, then DCS actually has a big impact. It actually is a significant protection for that firm, more so than for other firms. So it's a very good question. With respect to the intangibles, we actually thought exactly along those lines in the very beginning, but it turns out that sort of measuring asset intangibility, there's a lot of things that can contribute to asset intangibility in the end, and not all of them are associated with innovation. And so we ended up finding that we were getting very mixed signals there, and we then sort of became guided on the literature on innovation and said, well, let's focus on this area in particular. But I think in principle you're absolutely right. I agree with you. I think it's just empirically difficult. Yes, there are many different classes of dual class shares. Constructing the variable is extremely hard. What we had to do is we had to write, my PhD student, this is what you have PhD students for, Shu had to write Python code that downloaded the reports of all the firms over the sample period from the SEC, and then did natural language processing to actually find out if that firm had dual class shares or not. But we found that we could construct a dummy variable that way, but to actually say more, like how many share classes there are, what is the actual wedge? So what's the difference between the number of shares that have voting rights and the number of shares that don't have voting rights? That's much harder to do. But you're quite right. If one could do that, one could have better information. And the wedge is actually an important variable that we don't really look at. Q, yes, I agree with you. I don't think I don't think of it as a measure of growth opportunities. I think in the paper when we originally wrote it, we wrote it that way, but really I'm thinking of Q just in terms of valuation, just as a measure of valuation.
Ardi, before moving on, and question from the audience, do you think Australia should allow dual class shares?
I have mixed feelings about it, to be totally honest, but I think in the end, yes. I think that possibly one of the solutions that people are talking about is that firms should be allowed to issue IPO with a dual class share structure, but there should be a sunset clause. So because again, especially this paper of Kramer's that I pointed out a moment ago, it shows that the positive impacts of the DCS structure is limited to a window of about 5 years after IPO. So that might be a compromise that's quite reasonable. Afterwards, it seems that the benefits of the dual class structure, the protection from short-term investors and the ability to allow the innovator to keep true to his vision or her vision, that's important right at the very beginning when the firm is small and young and vulnerable. But as it grows older, then the governance, the negative governance aspects seem to dominate. And then you might want to eliminate DCS firms. What was the other question?
Don't think we have time for the other question,
great.
but
my apologies. I'll try and answer it by chat.
Yes. So the other question, I think you partially addressed the, finding the right weight between benefits of innovation and the risk of poor governance. I think the sunset clause could be one of those. And thanks, Ardi, for your presentation. So our last topic today is discussed by our third speaker, Dr. Danny Yeung, with his presentation on the art of investing in emotion. Danny, please feel free to share your screen. You have about 5 minutes. Thanks, Danny.
We're going to talk about whether it's possible to exploit how emotion can impact on prices in the stock market. Now, this is joint work, as I said, with my colleagues at Waikato. And just quickly, how we feel influence our outlook, judgment, and decision. And we can see that every day. Let me give you an example. If you're feeling happy, you're on your way home from work, you may decide to walk through a park on a beautiful sunny day because you're feeling happy. On the other hand, if as a child, you've been chased by dogs in parks and you're fearful of walking through the park, that will probably means you go home via bus or through Uber. Some of the strongest, powerful experience in life are attached to strong emotions: love, hate, joy. Think about your wedding day. Think about the day your child was born. So it posed the question of whether, similarly, emotion can have an impact on our financial decisions. Now, this is a topic that hasn't been done a lot in financial studies. I know of only a couple. And that seems like a very strange omission, because we know that the influence of emotion in decision-making has long been studied in behavioral sciences like psychology. Why is there this stunning omission in finance, given that we all are susceptible to emotions? So what we're going to do is this is the third of a trio of a study. We're going to use some of the results from a previous study to try to see whether that the impact of emotions are measurable and whether it is possible to construct a investment strategy around this. So as I was saying, we're going to largely base our trading strategy on evidence that we found from our first couple of studies in this area. Now, I guess our main contribution from the study is that emotion impacts on prices through two channels. The first channel, it's pretty intuitive, right? So first things first, let's have a look at this diagram. We're getting information from social media and news media. We're going to use textual analysis to draw out emotion from that area because we believe that mirrors investors' emotion. Now, once we got the emotion measures, right, we're suggesting, well, emotion will channel through company valuation and returns in a couple of ways. A direct channel where emotions impact on returns. And that's been found in just a couple of studies. In one study by Griffith, they use market level data to show that there is a short-term relationship between emotion, investing market-wide emotion and index returns. Another study by Formosi also looked at on a company level how returns and emotion can impact on returns. Again, that is for something like 4 or 5 days. They was looking at the returns period shortly after an announcement. Now, the contribution we make in the first 2 papers and that we're going to draw on in our investment strategy is this second channel. Now, I said on the previous page, the way we feel, and we all have emotions, feeling, impacts on our perceptions.
David, Danny, 1 minute.
Impacts on our perception, and particularly how that draws on. And so what we're going to look at is how information that come out of a company, we're going to use earnings announcement. And when that comes out, we're going to see how people underreact. So essentially, we're going to say, hey, what happens when a company announces good news when investor emotion about this company is high? We would expect a smaller reaction. On the other hand, if a company announces bad news, but people are feeling good about this company, you would expect they're more optimistic. So they will get a smaller penalty in the market. So that's what we're going to draw on. Now, quickly, data is something like over 20 years. We draw emotions data from Thomson Reuters market size indices. That data has been proven to be useful in a couple of major studies already. We're going to aggregate a single emotion. We're going to build a long-short portfolio. We're going to invest in firms that underreact to good news because of low emotion. And we're going to short firms that announce bad announcement when emotion is low or there's negative emotion about this company. And we also going to build onto our portfolio strategy, what we call a closeout or a trigger. We know that emotions are fleeting. And so what we're going to say is that, okay, if emotion, say from a good news, but announce at a low point, if emotion goes up by a certain amount, for example, 25% of standard deviation for this company's emotion measure, we're going to sell out. Now, I'm going to quickly go through some of the results. I'm just going to focus on, because of the limitation of time, a short holding period of 15 days and a trigger of 25%. You'll see that the weighted long short portfolio has an average return of 60% per annum. Now, over a similar period, the market did 9%. This portfolio have 60%. On this table here, we compare the performance of the portfolio, which is in blue, between 2003 to 2017, against what we call a benchmark portfolio. This benchmark has an average return of 20%, and it's built on one of the most long-standing anomalies called the post-earning announcement. Basically, companies tend to, continue to perform well after good news announcement and perform badly after bad news announcement. As you can see, the portfolio based on emotion consistently beat the benchmark portfolio, which already beats the market by something 11%. And finally, we went and put this performance through the 5-factor model. We found a positive significant alpha of between 1.3 to 1.4% per month. We admit that this portfolio, because it's balanced daily, it's got a high turnover, but even after accounting for transaction costs, two-way transaction costs of 50 basis points, we're still getting a return over that period of time on 26% per annum.
Thanks, Danny. Just quickly going back to David. David, maybe we can skip the summary and go to the comments in the interest of time.
Yeah, I'll just thank you, Lorenzo. I just wanted to make sure I outlined a couple of things on my comments actually referred to the summary. So I might just quickly go through those rather than doing a whole lot, if that's okay. First one is the technology that's been used here is based around the Thomson Reuters market psych indices, the TRMI indices. There's a bunch of those. One thing I'll make point about those is those are estimated using sort of textual natural language processing over various windows. And so what you get is actually sampling of those, and the construction associated with them is explicit and measured, but the underlying technology behind it's not very clear. What exactly they're using, what technology they're using for NLP, that's not really explicitly noted by Thomson Reuters. And that seems to me to be something which is, in this process, in a practical sense, something we need to think about a little bit. So just, if you go to the next slide, Lorenzo, I'll talk a bit more about that in a moment. just that I'm not sure I understand how they do it. In practical sense, these sort of strategies tend to have a very low barrier to entry, which is to say that the data is publicly available and you can use it, provided you pay the license for it. Everybody has the same data. So it's a little bit black boxy in the way that it works. So in practice, these things aren't very popular in an investment strategy like the ones that we run, because you don't tend to have any sort of value add. You just buy it and use it, and everyone else can do the same. So it gets arbitrage, potentially gets arbitraged out quickly if it works. And second thing I'd say about it is, in practice, rule-based trading strategies tend to be subsumed by other things, market momentum or fundamental momentum. So fundamental company momentum, analyst revisions and so on. So conflating those things together, you might find that trading strategies like these are actually part of a broader investment process, and the extent to which those investment processes are actually additive. The one you're suggesting is additive. On top of those, I've not seen that explicitly, although I haven't looked at this data set in particular. So those first two comments. My next comment is, can emotions actually be measured by textual analysis, or are you talking about sentiment? Are these things actually talking about sentiment, as in the belief that the individuals have about the future, rather than their anger, joy, whatever those measures actually are that are used by TRMI? And I don't know if I'm sure I understand that properly. Sentiment could really be put into two parts. There's kind of like the sentiment associated with future expectations of earnings, and sentiment associated with emotion. The first part could be permanent, the second part could be temporary. And it seems to me the analysis you're doing is picking up both of those rather than separating out emotion on its own. I'm not sure that's true or not, and I haven't sort of studied the area very well. But it seems to me that sentiment is known to work pretty well if you generate your own sentiment measures, and you're correlating with this. But actually, are you talking specifically about emotions, or are you talking about sentiment more broadly? And I'd say there's two things going on at once there. Perhaps one's a permanent effect, one's a temporary effect. I'll be interested in the views on that, because I haven't thought through it as much as I perhaps should have, but it seems to me it's something that would be sort of fundamentally underlying with what you're doing. Two quick comments in the interest of time, Lorenzo. First one is, there's been a lot of NAs in this data. I mean, no news for many stocks, particularly in some spaces, so lots of gaps in the data. And the data will also be permanently positive, because most of this news is emotions is positive, sentiment is positive. I think you cited something like 90% of numbers in terms of sentiment are actually positive, something like that. And they're clustered in certain sectors and stocks over time. Maybe it'd be useful to have some kind of a summary of the underlying data in your paper, if you haven't already put one in a later version, associated with what the population of these looks like and how many NAs you get, what sector they belong to, how many positives, those sorts of things. And one last comment, and I'll hand it back, is emotions or sentiment can be driven by what's gone before. So if strong price moves have happened prior to this announcement that you're looking at, that will influence whether it's positively or negatively aligned with emotional sentiment. So it might be that good news prior to what you're seeing influences the emotion, and consequently what you're seeing afterwards is the reaction to what's gone before rather than the emotional announcement at that time. Sorry, I've rushed that through a little bit, Lorenzo. My apologies, but hopefully that's useful.
Oh, that's okay. Thank you. I mean, we are obviously running a little bit behind schedule, but Danny, if you could please very, very quickly and briefly address David's comments. Thank you.
Thank you for those insightful comments, David. I'm also going to rush through my response, given the fact that we're going over time already. First things first, we delete anything we don't have data for, so for the NAs, the data itself, that's fine. We control for, just Lorenzo, can you bring up the previous slide? We control for the, obviously not in this paper, but in an early paper where we found the impact of emotion, we control for the returns leading up to the point where we estimate information. And you also mentioned something about somewhere in there about sector effect. We control for where we have a sector fixed effect. Now, I guess the point that I really want to highlight is a conceptual point. I'll finish on that point. Is the fact that emotion and sentiment are very different things. I know is often, people put it together. And in common speech, we do. We think, but emotion is spontaneous, it's physical, it's something that you can't control. It often is something you're not even aware of. Whereas the sentiment that we talk about, it's kind of process emotion. Sentiment comes from experience that we learn. For example, David may wake up saying, well, I think the market's got to go up. Well, in general, the market's going up. But that is a knowledge that we learn over time. And the other thing about sentiment is the fact that some studies have shown that, institutional investors are less subject to sentiment than retail investors, for example. And that is because sentiment requires a thinking process. it can be regulated. Emotions, however, you can't. So it may change your perception without you even knowing it. The other thing I want to talk about when we speak whether this data adds to the current data, for example, we are in a previous study, we looked at the correlation between sentiment and the emotion measures and the Baker-Workley index. The correlation is positive, but it's only around 46-47%. So we can add on something there. And my final point about the black box part, it's been shown in other literature that you can draw emotion from language. Now, textual analysis from text, that's a bit different, but over the last 10 years, they've come up with techniques to do that. And the other thing is, if you're concerned about that being a black box, you can always get a team of people to actually create your own emotional measure.
Danny, thank you very much. I'm sure the audience can see that these are very thought-provoking topics, and so we could go on forever, but unfortunately the time is ticking here. We would like to thank the audience, all the presenters, Jing, Hardy, Danny, and Dr. David Walsh for his very interesting research commentaries. I would like to flag that we'll have a blockbuster panel event in May on the current consolidation of the superfund industry following the EPRA's reform of superfund products. Panelists will include superfund CIOs, fund trustees, investment consultants from top superfunds and investment consulting companies. So please stay tuned by following us on LinkedIn. You can follow all the speakers and all the other researchers here at the Finance Department on LinkedIn. Thanks once again on behalf of the UTS Finance Department. We look forward to seeing you at the next event. Goodbye.